92% of financial advice on the internet was not built for you. Not because you are not smart enough, not because you do not earn enough, but because the entire architecture of mainstream financial media was designed around a default investor. And that default was never a woman. Here is what that has actually cost. Women, on average, retire with 40% less money than men, not because they spend more recklessly, not because they save less, but because every system they were handed, from the financial advisor sitting across the table to the YouTube channel they opened this morning, was optimized for someone else's financial life. And the strategy I am going to walk you through today is the one that finally made me understand why that gap exists, why it keeps growing, and more importantly, how you close it from the inside out. There is a second thing I want you to hold in the back of your mind as we go through this. The investment strategy we are about to discuss, most people who hear it will think it is simple. And it is, on the surface. But underneath that simplicity is a structural insight about how money actually compounds over a lifetime that almost no one in mainstream finance will say out loud to a woman directly. Stay with me, because by the time we reach the middle of this video, the way you think about your portfolio will be fundamentally different. Let me start with what retail investors are being told right now versus what institutional money is actually doing. If you open any mainstream finance channel today, the message is roughly the same. Buy index funds, hold for 30 years, diversify. Do not panic sell. This is not wrong advice, but it is incomplete advice. And the incompleteness is where most women get left behind. Because incomplete advice, followed precisely, can still produce a broken outcome. That is the part no one wants to say. Here is what institutional investors, pension funds, endowments, sovereign wealth funds are actually doing. They are not just buying and holding. They are allocating based on liability matching. They know exactly when they will need money, in what amounts, and they build their entire asset structure around that timeline. They do not invest as if money is abstract. They invest as if money has a job, a deadline, and a consequence if it shows up late. Now here is the gender-specific problem that no one talks about. Women on average live 6 to 8 years longer than men. That is not a small number. That is 6 to 8 additional years that your money needs to keep working after most financial plans assume you are done. The traditional 30-year retirement plan was built around a male life expectancy curve, which means if you are a woman following that plan without adjusting for your actual timeline, you are not just potentially short on money. You are running a fundamentally miscalibrated model. And a miscalibrated model, no matter how faithfully you follow it, will produce the wrong result. And there is a second layer. Because women historically entered the workforce later, took career breaks for caregiving, and earned less during their peak earning years due to the wage gap, they often have a compressed investing window. Less time, less capital in the early years, but more years of life on the back end. That is a completely different mathematical problem than the one mainstream advice is solving for. Which means the solution also has to be different, structurally different, not just slightly adjusted. So the investment strategy I want to walk you through today is not a hot stock tip. It is not a new ETF. It is a framework, a way of structuring how you think about money that actually fits the financial reality of your life, not someone else's. It starts with what institutional economists call a time-segmented allocation model. And the reason I want to explain this is not because it is complicated. It is because once you see it, you cannot unsee how much of traditional retail advice ignores it entirely. The core idea is this. You divide your money not by asset class first, not by stocks versus bonds versus cash, but by time horizon first. You ask a different question than most investors ask. Instead of asking what should I invest in, you ask when will I need this money? And the answer to that question changes everything about how you build your portfolio. Money you will need in the next 1 to 3 years should not be exposed to market volatility at all. This is your liquidity layer. High-yield savings, short-duration bonds, money market funds. This money has one job, to be there when you need it. It is not supposed to grow aggressively. It is supposed to protect your ability to stay invested everywhere else. Think of it as the foundation of a building. It does not look impressive. But without it, Nothing above it stands. Here is why that matters more for women than traditional advice acknowledges. Women statistically are more likely to face unexpected liquidity events, a career interruption, a health event for a family member, a divorce. These are not pessimistic assumptions. These are actuarial realities. And if your liquidity layer is underfunded, what happens is exactly what happens to most retail investors during a downturn. You are forced to sell your long-term investments at the worst possible time, not because you panicked, but because you had no other choice. The market did not fail you. The structure failed you. The second layer is your growth bridge. This is money you will not need for 3 to 10 years. This is where you can tolerate meaningful volatility because you have time on your side. Index funds, diversified equity exposure, real estate investment trusts if they fit your situation. This layer is where compound growth does most of its heavy lifting. This is where patience becomes a literal financial asset. And women, on average, are statistically better at this than anyone in mainstream media gives them credit for. And here is a data point I want you to sit with for a moment. JP Morgan's Guide to the Markets has shown consistently that missing just the 10 best trading days in the market over a 20-year period cuts your returns roughly in half. 10 days out of roughly 5,000 trading days. The investors who miss those days are almost always the ones who sold during a panic. And they almost always sold because they did not have a liquidity layer protecting them. They needed the money. They had no choice. That is not an emotional failure. That is a structural failure, and this framework fixes it at the structure level, not the willpower level. The third layer is your long horizon wealth engine. This is money you will not touch for 10 years or more. And this is where the women's longevity advantage actually becomes a financial advantage, if you use it correctly. Because you have more time than most financial plans assume. More time means more compounding. More compounding means the quality of your investment choices in this layer compounds differently than they do for someone with a shorter runway. This layer is where you can hold higher risk, higher return assets, individual equities, growth-oriented funds, even a small allocation to alternative assets if appropriate for your situation. The key is that this money is genuinely untouchable for a decade, which means you are not managing it emotionally, you are managing it structurally. And that distinction between emotional management and structural management is one of the most important things I want you to take from this. Now, I want to stop here. We are about halfway through, because I need to address something that most financial content will never say directly to you. There is a behavioral economics concept called loss aversion. It was identified by Daniel Kahneman and Amos Tversky, and it describes the fact that psychologically, the pain of losing $1 is roughly twice as powerful as the pleasure of gaining $1. This finding has been used, often subtly and sometimes cynically, to frame women as more risk-averse investors. The implication is that women are less suited to aggressive investing because they feel losses more acutely. This framing is not just incomplete, it is structurally misleading. Because what the research actually shows is that women are not more emotionally reactive to losses. Women are more rational about avoiding unnecessary risk. One is a weakness, the other is a feature. And the financial industry spent decades calling it the wrong one. Studies from Fidelity and Vanguard have both found that women outperform male investors over the long run, not because they take more risk, but because they trade less, hold longer, and make fewer panic-driven decisions. The investment behavior that gets labeled as conservative or risk-averse is actually the behavior that the most successful institutional investors try to build into their processes by design. Women are not doing a worse version of investing. In many measurable ways, they are doing a better version and getting almost no recognition for it. So when I say this strategy is built for you, I am not saying it is a gentler version of real investing. I am saying it is a more precise version of investing, one that accounts for your actual timeline, your actual risk of liquidity events, and your actual behavioral strengths. That is not a consolation prize. That is a structural advantage that you have every right to fully own. Let me now go deeper into something that most discussions of this framework leave out entirely. Sequence of returns risk. This is the hidden variable that can quietly destroy a retirement plan that looks perfectly fine on paper. Most retail investors have never heard this term. Most financial advisors do not explain it unless you ask. And yet, it is one of the most consequential risks for anyone with a long retirement horizon. Here is how it works. Two investors retire on the same day with the same amount of money. They both hold the same portfolio. They both withdraw the same amount each year. But one of them hits a market downturn in year 1 of retirement. The other hits a market downturn in year 15. Same portfolio, same withdrawal rate, dramatically different outcomes. The investor who hit the downturn in year 1 runs out of money significantly earlier, sometimes by a decade or more. Not because they did anything wrong, because of timing, because early losses in a withdrawal phase shrink the base that future growth needs to recover from. The math compounds against you in ways that are almost impossible to recover from once they start. This is why the time-segmented framework is not just a nice organizational tool. It is a defense against sequence of returns risk. Your liquidity layer means that when the market drops in year 1 of your retirement, you do not have to sell equities to pay your bills. You draw from the liquidity layer. You let your equity positions recover. You do not lock in the loss at the worst possible moment. And for women with longer life expectancies and therefore longer withdrawal periods, this risk is mathematically larger. A woman retiring at 62 may have a 30-year withdrawal period. A man retiring at the same age may have a 23-year withdrawal period. Sequence of returns risk compounds over that additional 7 years in ways that most financial plans simply do not price in. Which means the standard advice, built around a shorter withdrawal window, is not just slightly off for women. It is systemically off. The practical implication is this. Your liquidity layer in retirement should probably be larger than standard advice suggests, somewhere between 2 and 4 years of living expenses, not the traditional 6 to 12 months. Because you need a long enough buffer to weather a full market cycle without being forced to sell. And a full market cycle from peak to trough to recovery can easily take 2 to 3 years. Your buffer needs to outlast the storm, not just acknowledge it. Now let me address something that sits underneath all of this. The behavioral architecture of staying invested. One of the most robust findings in behavioral finance is that the single biggest predictor of long-term investment returns is not which funds you pick. It is not your asset allocation in the abstract. It is whether you stay invested through volatility. And the single biggest reason people do not stay invested is not fear of losing money in the abstract. It is fear of losing money they cannot afford to lose. Money that should have been in a liquidity layer but was not. This is the structural insight I want you to take from this video. You do not stay invested through willpower. You stay invested through structure. You build a financial architecture that makes staying invested the path of least resistance, not because you have suppressed your emotions, but because you have designed a system where you do not need to sell when markets fall. Willpower runs out. Structure does not. That is what institutional investors have always understood. That is what retail media, especially the version aimed at women, has consistently failed to transmit clearly. They simplified it down to stay calm and hold on. But calm is an emotion, structure is a system, and systems beat emotions every single time over a long enough horizon. Let me now pull this together into a framework you can actually act on. The first thing you do is build your liquidity layer. Look at your actual monthly expenses, not what you think you spend, your actual bank statements. Multiply by 12, at minimum. That number, held in a high-yield savings account or equivalent, is not dead money. It is load-bearing money. It is the foundation that makes everything else possible. Without it, you are investing on a foundation of risk you cannot see. The second thing you do is get honest about your timeline. Not a generic 30-year horizon. Your horizon. When do you want to have the option of not working? What are the financial milestones that matter to you in the next 3 years? Not the next 30. What liquidity events are statistically likely in your life? Caregiving responsibilities, housing transitions, health, and have you funded the buffer for them? This is not pessimism. This is precision. The third thing is to separate your growth bridge from your wealth engine. If you are investing everything into the same account with the same mental framing, you are not managing risk. You are just owning a pool of assets with no structural logic. Give your money jobs. Give each layer a timeline, a purpose, and a strategy matched to that timeline. Money without a job description drifts. Money with one compounds. And the fourth thing, and this is the one that most people underweight, is to revisit your liquidity layer during every major life transition. A raise, a new job, a marriage, a divorce, a child, a parent who needs support. Every one of those events changes your liquidity exposure. Your investment strategy should not be a set-it-and-forget-it document. It should be a living architecture that you audit the way a smart business owner audits their cash flow, regularly, honestly, and without waiting for a crisis to force the conversation. Here is where I want to leave you. The 40% retirement gap between men and women is not explained by intelligence. It is not explained by financial literacy. It is explained by access. Access to frameworks that actually fit your financial life. Access to advice that does not assume you are a secondary decision maker. And access to the kind of structural thinking that institutional investors have always used, and that retail media has consistently simplified out of existence when talking to women. You now have the framework. Not a hack, not a shortcut. A structural model that accounts for your timeline, your risk profile, your behavioral strengths, and the very real financial asymmetries that the standard advice ignores. This framework was not built for someone else and handed down to you. It is built from the actual shape of your financial life. The question I want to leave you with is not what should you invest in. That question, by itself, is too small. The question is, looking at your financial life right now, which layer is most underfunded? And what does the structural consequence of that look like not in 30 years, but in 3? Because the gap does not close in 30 years. It closes in the decisions you make this quarter, this year, and the year after that. And you now have the architecture to make those decisions with a precision that most investors never access, and that mainstream financial media never thought to hand you directly.